Hey, good morning, traders and investors, and welcome back to the Wednesday live stream show. Bennett Tyndall with you. Hope you guys are doing well this morning. My goodness, quite the recovery effort in the markets across the board. We've seen nearly a 78% retracement in the S&P, nearly a 61% retracement in the NASDAQ. If you attended our recent Navigating Volatile Trends webinar, you may not be surprised by the recent uptrend. We've been looking at the pullback in the indexes as simply just that, a garden variety correction, setting us up for a move to new highs. We did acknowledge an alternate view that we assigned about a 20-25% probability to, but for now it does look to be upside resumption. No technical difficulties this morning. I'm running a bit under the weather here myself, but we're gonna get through the show. We wanted to bring you guys an update, of course. Hey, before we get into the charts, I'm going to go ahead and bring in the team, and then I'm going to take you through the indexes. We've got a guest on deck here in just a moment. Good morning, Terry. Good morning, Alex. How are you guys doing today?
Good morning, guys. How you doing?
I'm doing as good as I can be with the little bit of a cold I'm facing here. But hey, man, if there's anything that'll get you out of your head and the congestion, it's the markets and the move we've seen off the lows. How are you guys doing? You doing well?
Yeah. I'm everything's well. Getting out, working in the yard, starting to, see the springtime. The buds are budding, the flowers are starting to bloom. So, yeah, we get to put the winter behind us and move on.
It's that time of the year. What about you, Alex? We missed you last week. How are you doing?
Yeah, I'm as I said, feeling more normal today than the other days. just a joke. Actually, the spring is also coming here. So as we talked internally, allergies all around. So
for sure.
Most of the people are sick with the flu. My son is also sick. My wife is sick. So I mean, it's usually when the season turns, the organism reacts. So half of the Belgrade is actually sick. So I mean, it's a kind of a natural thing. So I'm not. So I have a little bit of better immunity, it seems.
It's that time of the year. It certainly seems to be that time of the year. Glad you're doing well. I know you were going through that, I think, a couple of months back, but at least you're not picking up the bug that's going around this time. So hey, let's jump into the markets here. We've seen a pretty solid recovery effort across the board, as I mentioned, out of the open. I want to take you through the indexes, look at the S&P, acknowledge the alternate scenario, which we continue to just keep on track as an alternate in the event Plan A does not go our way. Elliott Wave is all about having context when those circumstances hit. So I'm going to take them through the indexes. If there's anything else you guys had for the open, I know Bitcoin continues to trade north of 40,000. Alex will take you through that just briefly during this update, and then of course tomorrow for Crypto Lab. Anything else pressing this morning?
We'll get to it.
Yeah,
all right. I'm all over the place. Like I said, I'm running under the weather. So hey, let's hit it. I'm going to take you hard right edge of the Motive Wave platform, and then we'll be back and bring in our guests. Sound good? Catch you guys in just a couple of minutes. All right, welcome back, and thank you guys again for joining us. We do appreciate it. Can you believe we are approaching the end of the first quarter here, already 25% of the way through the new year. Time certainly does fly. So let's hit it. We're going to go hard right edge of the Motive Wave platform, and I'm going to take you through the S&P 500. We're looking at a daily chart going back to the COVID lows. I don't think we'll ever forget that market decline. Really quite fascinating how, if you go back to really Q4 of 2018, that decline was really already on the chart as per the Elliott Wave pattern. Coming off of the COVID low, I've discussed this multiple times that I continue to view this as only a three-wave trend. What that means is in the event our wave 4 is violated and we do break the February 24th support, the three-wave move into early January of this year would not complete and satisfy the requirements of our higher degree fifth wave. A higher degree fifth wave needs a motive trend. And in this case, our alternate that we acknowledged was in fact the motive diagonal. I don't even think this is really even a possibility at this point. I continue to track it in the event. As mentioned, we do break the February 24th area support. Obviously, we've been in a season of uncertainties, if you would, from the situation overseas with Russia and Ukraine to, of course, the inflation situation and how the Fed's going to navigate that this year. But we've been more optimistic, and we've been continuing to view this as a wave 4 correction, finally pairing up to our wave 2 flat, which occurred in 2020. That was the first highest degree or higher degree correction that we saw from the COVID low. So let's get off of the daily chart, and I'm going to focus in on orange 3 down into orange wave 4. We're down into a 1 hour time frame, and when we met last week, we acknowledged a zone of resistance that we expected to deliver at least a short-term pullback prior to seeing the continuation. And if you'll notice here, March 23rd, that's last Wednesday when we met, what we were looking at here, and I'm going to go ahead and zoom in on this price action adjust scale. I'll go ahead and circle the February 24th low, which is where we saw the evidence of our first motive development. So this was the first trend establishing wave post-correction that we identified to potentially deliver this continuation. The wave 2 pullback was a little bit unusual, but everybody knows we were awaiting the March Fed meeting, and there was a lot of uncertainty as we were navigating that retracement support. Ultimately, we held the 786 retracement into the March 14th low and proceeded to rally in green wave 3. When we met last week, we acknowledged the fact that there was resistance within wave 3 with its third wave at 45.6257. This was a standard 161.8% projection of wave 3 compared to 1. And we expected that would deliver a wave 4 pullback potentially into the area of the previous fourth. Now, the pullback was fairly shallow. It was 61% compared to wave 2, so the magnitude of wave 2. And after completing that correction, we have since seen evidence of a 5-wave continuation. Now, if I introduce a momentum indicator, relative strength, that we often utilize to kind of help substantiate the various segments of an Elliott Wave development, you'll notice that RSI peaked on the 1 hour chart back on March 21st. That's typical of wave 3, of sometimes an even higher degree wave 3 if you have enough data to work with. And so what that tells me is, given the upside resistance, which is now offered from 2 degrees of trend as well as a major retracement level, I am anticipating this zone of resistance when viewed in combination with the momentum divergence that we're seeing. I think we're getting ready for a wave 4 pullback, and we could set up for that into today's session, maybe Thursday or Friday. The zone of resistance, and let me go ahead and clean this up here, bringing this in 1 degree at a time. The 1618 of wave 3 compared to 1 came in at 46.19. We met that yesterday, we consolidated, and then we saw continuation. If we look inside of green wave 3, we have wave 5 and 1 equality, which is very common when you have an extended third wave. And then in addition to those 2 levels, we also have the 78.6% retracement of the entire decline peak to trough into the February 24th low. That suggests that we should be gearing up for a wave 4 pullback. Now, in terms of the alternate, it's within this wave 4 pullback that we can really begin to dismiss that alternate scenario, which suggests we are going to break the February 24th low and see a more significant retracement of the post-COVID low rally. That alternate, as you can see over here in yellow, would suggest, as many within the analyst community have been voicing, that this is a corrective rally and this is some sort of a counter trend move setting us up for continuation to the downside. Now, the differences here are this would complete a 3-wave structure into the 786, and this would imply an impulsive move to the downside, where alternatively, and in our preferred view of markets, we would see a correction in wave 4 and then set us up for a move likely to new highs in the S&P. So the S&P continues to trade well from the February 24th area low. As mentioned, if you attended our recent Navigating Volatile Trends webinar, this should come as no surprise. We had discussed the possibility of this being 1-2, looking for that continuation, and I'd love to see the breakout. So that's the S&P. Over to the NASDAQ 100, we have a similar development at work here, except in the NASDAQ, the low for the index was actually made on March 14th, as opposed to February 24th, where the S&P found its low. All that means is we have one less degree of trend to work with. So zooming in here on the 1-hour chart for the NASDAQ 100, we now have a zone of resistance just above the 618 retracement of the entire 2022 decline. That should set us up for a wave 2 pullback. It's within the wave 2 pullback that I think we will truly dismiss the alternate scenario and set us up for continuation in wave 3. Looking to the Dow Jones, looking at the Dow Jones, this is one index that really never offered an alternate bearish scenario, or a scenario that would suggest further downside and consolidation. Here we have that same 1-2, 1-2, up in 3, down in 4, approaching resistance between 35,608 and 35,889. So markets continue to trade well. Again, if you're interested in staying up to date with us on a more regular basis, you can check us out, tradinganalysis.com. We do provide updates every evening. And then over to the Russell 2000 here. The Russell 2000 has been a bit, it hasn't seen as significant of a retracement, and it's been a bit more difficult as you know, historically has been for the index to identify some of the smaller subdivisions. But we do have evidence so far of just 3 waves off of the bottom. I would love to see this complete wave 3, enter a wave 4 pullback. If in fact we do violate that wave 1 and wave 2 position and see overlap between these 2 corrections, we could entertain the idea that this is actually a leading diagonal. That's still a mode of development, and that still implies upside continuation. And then finally, we'll take a look at the chart of the SMH. The SMH is one chart that we have continued to view as one of the most important charts in the market. We had a garden variety 3-wave pullback in our wave 4 position. Wave C, if you take a look at the time comparison to wave A, was a less significant angle of descent, which would suggest that is, in fact, a corrective wave as opposed to the start of a new impulsive downtrend. And here we are, up into the 618 retracement, looking for a pullback here in wave 2 in the short term. And then the other chart we'll take a look at probably this evening in a public update is the chart of consumer discretionary. But I'm going to go ahead and leave it there. We've got a couple of other things we want to cover this morning. Again, I apologize if that analysis was all over the place. I'm running a bit under the weather. But hey, we're going to jump over to the Advisors Corner, bring in our guest, Todd Gordon of New Age Wealth Advisors. And we want to talk about, he's going to take you through the yield curve inversion that you've probably heard so much in the media and has been kind of a scare tactic at some time. So Todd, good morning, sir. How are you doing today?
Good morning, guys.
Glad to have you.
You know, I'm not just, you know, advisor in New Age. Come on, I haven't dropped my founder title.
That's right.
I'll never drop that.
That's
Come
right.
on, man. Get on that. Get that straight.
Founder of Trading Analysis and New Age Wealth Advisors. Glad to have you on, man.
Damn straight. Hey, good job for having the flu, bud.
I appreciate it, man. I'm trying.
You didn't miss a beat. So hope you guys are doing well. Good morning, Alex, Terry, Bennett. Great job. Yeah, just want to hop in real quick. And, you know, everyone's talking about the 10-2 spread. And it's, you know, it's so important for traders and investors to understand, you know, the macro, which is really how we set this business up, right? Maybe we have, you know, Alex obviously very in tune with the macros, but, you know, that's how I learned to trade and invest. And that's how I was taught. I always have an idea of where, you know, the global macro flows are. And those are the 4 major asset classes, fixed income, equities, commodities, and currencies. And, you know, that's kind of the foundation, I think, of really, you know, how you should approach the markets. You just can't get in there and sling shares of semis and Apple and stocks and not have an idea of what the other asset classes, what impact they have. And sometimes they have a big impact and sometimes they don't. Correlations come and go. I think that's a really good thing. You have to be in tune to the market, to your stock trading. You know, you can even throw a 5th asset class on there. Is crypto the 5th asset class? Possibly. So it's really important to understand that. And fixed income, I think, is the least understood. So I just want to touch on that quickly. But first, I just want to, you know, from longer term point of view, and Bennett, don't go anywhere. I just want to show you my chart's longer term. I'll throw go to meeting up if you don't mind.
Yep.
Just real simply, on a portfolio management, we're running millions of dollars and clients with all sorts of different tax situations. To start, we're not in and out actively. We're running longer term portfolios. We're rebalancing and putting new stocks in, kicking bad stocks out every month to 2 months, I would say. So we always keep an eye on what the market is doing every single day because we're constantly assessing the portfolio. Just some of the longer term, simpler wave counts that I'm looking at to sort of guide me. NDX here, this is the monthly chart going back to 19. It's a really hard chart to go back, I think, and I think Bennett would agree, going back to the 08 low and even the 2000 low. There's a lot of subdivisions on an otherwise very straight upward slope. But near term, guys, there's just two clusters of fib resistance that we can target, right up here into just about 20,000 NASDAQ. It's unbelievable. 20 and then up to around 25 longer term. And then SPX, we cleared the first zone of resistance in this. What I'm tracking is 5 of 3. And it actually looks like we're kind of setting back here in a little wave 4 using that as support. I think the immediate upside target is sort of a wide zone, 5,500 into 6,000. And I mean, that's how I'm operating. And I'm going to carry long stock positions up into this zone. And if the market starts to react to it, then, we'll certainly adjust. The sentiment that we're coming out of has been so bearish. There's so many different examples of like AAII investor sentiment. The amount of bears exceeded the COVID lows, but matched the credit crisis lows, all because of inflation and all because of where, now lately, where the yield curve is. And so many people are saying, well, breadth has deteriorated and there's so many stocks that are in bear markets. And I was looking at this on stockcharts.com, and this is the percent of S&P 500 stocks above the 200-day moving average. Okay, and down here is the actual S&P. Just looking at this in the 21st century, I was shocked by this. I didn't realize it's only like 37, 38% of stocks that were still above the 200-day moving average. Okay, and you look at the depths of that from prior corrections. This is one of the more shallow corrections that you'll find in terms of using this indicator, which is amount of stocks above the 200-day moving average. I mean, it's not a good old clean, pardon my French, but ass kicking until you get 10% of stocks above the above the 200-day moving average. So I think the argument from a breadth point of view is kind of ridiculous. I think the NASDAQ and small cap, if you're looking at a VTI, total stock market index, the amount of stocks in bear markets, I say good. Why do all stocks have to be growing earnings and growing margins and improving fundamentals along with improving technicals? That doesn't make sense at all. There's always going to be haves and have-nots in the stock market. So I say good. And I say that's why we need to be more of a stock picker than ever. So that's that. All right, so let's get into the yield curve here real quick. I'm not going to take too much time. So this is the, oh, come on, baby. Come on. I'm squeezing across several screens. Here we go. Okay, so this is the, this is going to be, actually, let me start with this one. Let's do 10-2. So this is the 10-2 spread. I'm going to take the S&P off. There's a lot going on right now, real quick. Okay, so the 10-year is in orange and the 2-year yield is in blue. The purple is the 10-2 spread. Okay, so let me just start there real quick and just set this up. 10-2 spread is approaching the zero bound, which if you look at this gray shaded area, those are prior recessions. Okay, recessions in the US. So when 10-2 hits a low, you tend to go 18 to 24 months until you're into a recession. Low, recession, low, recession. Real quick, one, we already had a recession. It was a man-made recession, but it was a recession. It was very short. Two, the thing you'll notice is the starting point for this was very low compared to prior cycles. rates are significantly lower than where they have been in the past. Okay, and if you overlay the S&P on there, I think that's important because rates didn't really reset like they did here in terms of a large spread to set up a significant stock market expansion. They didn't reset like here to set up expansion. They didn't set up here, set up expansion. I think personally, and I'll leave this to Alex, a discussion another time, I think the whole curve needs to be shifted up. I think investors starting to realize the futility and uselessness of bonds. I think bonds will eventually push lower. Interest rates will move up. Yield curve shifts up. I don't think the Fed is going to cover and follow in the near term. And that brings me to the next chart, which this is the difference between the 2-year yield, which I was just showing. And this is what everyone's talking about, the difference between the 10 and 2 and why it's approaching that zero bound, that recession is imminent. Well, the Fed is actually moving not at the 2-year mark, but less than 2, down around 1, or 6 months or 3 months. So this is a spread between federal funds rate, where the Fed actually moves rates, and the 2-year. And there's a couple points here where you'll see that this is actually getting very steep. So what this means is the 2-year yield is going up while federal funds is going sideways. So it's up around 2.02, and the last 2 significant times it was that high, look, this was back in 2002 actually. The 2-year yield spiked up, federal funds rate didn't go anywhere, and this yield spread settled in. Same thing here in 2010. 2-year yield moved up, trying to get the Fed to raise rates. That didn't happen for a long period of time. Now, is the Fed behind the curve? Possibly. But just because the 2-year yield moves up doesn't mean the Fed is going to raise rates to catch up to where it is. Sometimes that 2-year yield catches down. Okay. And there's been so many people just saying recession's imminent, get out of stocks because of yield curve inversion. I'm saying, well, hold on. There's a whole different side to this story. And I think you as a trader and investor, you need to understand this. You have to understand how interest rates and yield spread works, because it comes down to, do you get out of stocks or do you stay in stocks? It's a big decision. Okay. So I did a video last night just talking about financials, going in a little further. And as the yield spread has come in, and as the way banks, this will be a really quick explanation. I did a video last night on my YouTube channel on Todd Gordon describing this, but you've seen financials fall out of favor pretty significantly. I am still overweight financials, so I am talking my book and our portfolios. But you can see XLF has certainly fallen out of favor here relative to the S&P. And again, that comes back into what they call the net interest margins. So what the down and dirty of this, guys, is basically the way they simply explain it is banks borrow from customers. You and I put our money in the bank very short term. They pay a small rate, and then they lend out longer. They do longer term loans, 5, 10, 30 years, charging a much higher rate. And that difference is the spread. A lot of people are saying we'll get out of financials because that 210 spread has gone to zero. How can financials make money? So I did a deep dive yesterday, and I went through this quickly, and I said, well, wait a minute. If financials, if you got to get out of them, where you have to understand at what rate, where are financials borrowing money? And I spent a good 2-3 hours scouring the internet. And they used to do this net interest margin study, but they discontinued it in 2020. So there's 2 sources that I could find to give us more details to where financials borrow. This is one, and it should be right here. Okay, this is a paper written back in 2017, found on a Fed website. The mismatch right here, aggregate bank assets have an average estimated duration of 4.2 years versus 0.4 years for liability. So what the hell does that mean? That means banks take on liabilities, they borrow from us, the depositors, and then they own assets, which are yield producing loans, and the average duration on those loans is 4.2%. So this tells you right here, they're not borrowing at the 2-year yield. They're borrowing at less than a 2-year, more like a 3-month yield. And if you paid attention to what we just went back to, the 3-month federal funds and 6-month interest rates are still very much pegged, while the 2 years moving up. And then the other part about this is this paper right here, which is from the Cleveland Fed. Again, there's not a lot published on this. This goes back to 2014. So you just got to realize that. You look at the maturity of liabilities, average maturity of what banks are borrowing. So small banks, regional banks, 3 months, 3-month duration, 35%, 3 to 12 months, 15%, say 50%, give or take, less than 1 year. And then get down to average liability maturity of large banks. This one locks it up for me very consistently above 50% under 3 months, and then 1 to 5 years is 25%. Okay. So, I mean, that's a huge, and then down here as well, you have 5-7%, 3 to 12 months. So call it altogether 60% under 3 months. So all I'm saying there, guys, is banks are borrowing very much in the short term, number one. And number two, so that tells you don't kind of fall victim to this. Everyone's saying because the 2-year yield is doing this. One's the Fed's raising rates, and two, financials can't make any money. Just take a look at XLF. There's Lulu after earnings. Take a look at the financials. For me, I don't see, this is kind of like when people are telling us 3 weeks ago that Apple's going into a massive bear market. Just looking at the chart, do you see anything that's bearish about this chart? Because I sure don't. So I just wanted to kind of put that in front of you guys. I'm certainly watching energy as it's very much tied to the inflation direction of long-term interest rates. I'm looking to piece out of our overweight position in energy. Financials, for now, I'm going to stick with it. I want to see sort of a resurgence, kind of see if we can break to new highs. I do like the regional banks and stuff like that. But you can't deny the rotation back into growth, which I know Terry's going to talk about, which I love. Absolutely love. And I think that shifting of the longer term yield curve, people are getting used to the idea of higher rates, investing in a world that inflation is going to be real. The last thing I'll say about this is Tom Lee I'm a big fan of his work and friends with him. He's making the point that the real yield curve, if you take inflation rate minus the various yields along the curve, it's still very much steep. It's still very much a healthy yield curve. And I think because you can borrow very cheaply, right? Because if you're taking a 4 or 5% or 3-4% loan, but inflation's at 7%, you're getting paid 4% a year to borrow. That's leading to a rotation back into tech, which matches up very well with the technicals, which is why Bennett and I were on top of it, showing that semis were going to lead up and out at 2 weeks into that ABC low, which is exactly what happened. So there's a lot happening. It's very complex. I'm sorry to bar you over, but it's important you guys understand. I know you want to get back to counting waves and looking at different companies to trade, but it's super important from at least from my point of view. Hopefully that helps. Back over to you guys. Thanks for the time.
Absolutely, much appreciated. There we go. We're getting some evidence of the flu. Good job, Todd. Excellent work as always.
My pleasure.
So Todd, maybe we need to be looking at the 3-10 spread, 3 months, 10-year spread. I don't know. Is there a 7-year? But I don't think there's enough volume in a 7-year to.
No, I can pull that up real quick. Am I still showing?
Well, no, I'm just saying that falls right in line with what you're talking about. Is rather than the media focusing on the 210, they need to be focusing on the shorter month. Because I do think you showed the XLF chart there with downward momentum. It is holding relative strength fairly steady, but while it takes this consolidation, so. I'm with you. I don't count the financials out yet. I see them taking a little bit of stress. Obviously, that's what the charts are showing us.
They're sideways for sure, but they're not rotating over. And there's same thing. There's so many haves and have-nots. Like we have regional banks, we have some asset managers and full line insurance companies are doing extremely well in here. Schwab is a large holding in our value portfolio. But there's others that are drastically underperforming. That's why it's so important to be a stock picker in here. And Bennett, did you say Yeah. Is the screen still up or no?
Yep, you're up.
Oh, yeah, Terry, this is the 10-year 3-month spread, and you can see it's coming off a very, very flat zone, and we're very much inverting. We're very much normally shaped. It's going up. It's not moving down like 10-2 is. And I mean, you could throw the S&P. I know we're getting a little crazy here. Let me just do S&P over 10-3 spread. S10-3 spread. Why is there 3 on there? Yeah, so purple and orange. Oh, S&P total return. Got it. They want to both be on there. Okay. So 10-3 spread is in purple, moving up, and there's the S&P right there. So we're still very, very much moving higher, and we actually have seen much wider spreads than this. And again, a wide spread is the shape of a healthy economy. The question is, what's the correct yield curve? 3-month, 2-year, or 10-year 3-month, or 10-year 2-year? And the Fed, even if they raise 7 times, it's still going to be a 1.5 federal funds rate, 1.75, which would still make it upwardly sloping, which is still the shape of a healthy economy. I think we're a long ways away from inversion. I think people are getting way too ahead of themselves on this.
Very good. Much appreciated, Todd, as always. And if interested, please check out his channel. You've got some content rolling over there as well. Tomorrow at the
we got to get you over as a guest, Bennett and Terry and Alex. We'll put you on the guest list.
Sounds good. Looking forward to it.
All right, guys. Have a good rest of the show. We'll see you.
Appreciate it, Todd. Catch you in a bit.
Thank you very much, Todd.
My pleasure, guys. Thanks.
Let's transition to sector focus. We're going to pass the screen over to Mr. Terry Long. He's going to take you through the rotations. A lot of key developments here as we see markets attempt to defend their February and March area lows. So, Mr. Long, sir, you ready to jump in?
Yes, sir. Let's go.
All right, here we go. We'll be back on the other side.
Hello, traders. I'm Terry Long at TradingAnalysis.com with your weekly sector focus. So the common theme that I saw in last week's trading was positivity as the markets continued to extend the gains that were made from the prior week's surge, though not quite as an accelerated pace. Still, the S&P netted a 1.79% gain for the week. The Index 100 rose another 2.32%, making its 2-week total rise here 10.73%. That was a huge run up last week. Sorry, the prior week. This is last week. Tuesday's continuation move just, to the upside took the S&P back above its 200-day simple moving average for the first time since February 16th. And the index easily recaptured its 50-day simple moving average line that it has been trading below since January 4th, but it was just still shy a bit of the 200-day. Now, last week, over here, this is sector performance. The materials and the energy sector saw the best gains last week, both up about 3.7%, while all 11 sectors achieved positive returns. However, real estate, healthcare, and consumer discretionary did see less than 1% gains. Now, so far this week, let me get this out of the way. I'll just close it. There we go. Get that out of the way. Monday and Tuesday's price action here has actually added another 1.95% to the S&P. It is now back within 3.5% of its all-time highs. Now, the index tacked on another 3.29% Monday and Tuesday's trading, and but it remains about 8% below its all-time highs. And then jumping out to lead the markets higher this week are the consumer discretionary and the real estate sectors. which made those shy returns last week, but now exploding much higher this week. And we also have technology up here as well, and there's communication. So discretionary real estate, technology, and communications outperforming the S&P. While on the downside, we have utilities, and with the volatility continuing in the energy sector, the XLE seen declining 2.73% in early week trading. There was more volatility overnight, so this is, if I bring this in here, this has got some pre-market action in it here. We still see the consumer discretionary sector outperforming. Where'd my energy sector go? There it is, 1.8%. So gaining a little bit back there today. Let's move on to the relative strength scoreboard. And the momentum does continue to fade in the energy sector while we are maintaining a constant relative strength ratio of this 120. I'm going to zoom in over here a little bit closer to the rest of the group. The staples sector is also seeing momentum fade. It was sort of holding its relative strength steady, but now you're starting to see a little bit of a southwesterly turn. And actually, I see an acceleration. If you see the length of the line segment here, the measure in their term of velocity, we are seeing an increasing velocity of downward momentum. That's going to push the XLP down in here into this weakening quadrant over the next week, I believe. Now we're also seeing the utility sector. It gave us a brief head fake south. It resumed another push higher, and now we're seeing that resumption back to the south, roll right back in again. That was just animate. So the last tail segment here represent Monday and Tuesday's price action added in here to these guys. We're also seeing this financials, like Todd was saying. We've seen this financial sector continue to see momentum decay. And if you notice, we went from a green trend to a yellow trend, and that tells me that the price action in the weekly trend is starting to weaken here in financials. Now, the industrial sector, it still remains here in the leading quadrant, but it's also seeing with some declining momentum. So there's definitely a rotation happening. Whenever you see a major turn, we call them hooks. You're now seeing hooks south in these value plays. Okay, healthcare remains up here in the leading quadrant. It has been gaining both momentum and relative strength simultaneously, but I'm also getting a hint of a turn south just now starting up in there. Materials sector, it's kind of seen alternating in a zigzag fashion, very short tails, so it's fairly comfortable sitting in its position right now, and the zigzag just kind of tells me it really doesn't have much directional push either way. Now, the real estate sector is another one that's just hanging out down here in the weakening quadrant with no clear direction or intent apparent. And the only thing that I can see rotating back and forth from last week to this week is the color structure reverting back into a green, which tells me a leading weekly price trend. Now, down here in the lagging quadrant, this northerly hook formations continue to unfold in both the technology and the consumer discretionary sectors. Now, while those vectors remain red, we have seen the headings now turn back slightly to the northeast in both the XLK and the XLY. Now, why is this important? With a northeasterly heading, that means the sectors are now gaining both momentum and relative strength relative to the benchmark S&P. Now, a further continuation of this development will be a positive signal, I think, to further price appreciation in these beaten down growth sectors. Over here, the communications sector still remains very reluctant also to tell us its hand, as it just sits here quietly on the border between the lagging and improving quadrants. Now, real quickly, I want to show you price chart here in the healthcare sector as markets are opening right now. There's the opening bell. And we've seen some positive price action moving here in healthcare. And with a break above this trend line, I think now we have formed this break above 137 has pushed me into what I see as 5 waves up, Bennett. So 5 waves up is a new impulsive move to the upside, and we'll be looking for a completion of that move and then some kind of consolidation that possibly take us back to some prior support levels where we should see further development there. Also, let me show you the materials sector real quick here, where we actually had thought we were going to fall into a triangle with an A, B, C, D, E move, but I'm starting to question this triangle. It's not invalid yet, but I'm looking at the development here in this pattern, which almost looks much more impulsive to me. And if we keep pushing higher, we're ultimately going to invalidate with the D wave, cannot go above the B wave. And if we just see continuing push above this this 90 handle here, I would say that we probably have to go back and anchor the March 7th lows here in the materials sector and consider that we've started a new impulsive trend to the upside. So I'm starting to think that there's some better things happening in materials. We've been talking gold, tracking the gold and the gold miners. And you can see that we've been projecting this ABC decline, and that does continue to unfold here in the precious metal itself. We didn't really get much of a B wave bounce unless there is more of this B wave to come, and I could push that further out there and say ABC in B, but ultimately it's still going to decline further down into a little bit larger consolidation in this period. Excuse me. I'm getting dry throat here. Let me get something to finish.
No worries. I'm rubbing off on you. I transmitted it across the vMix.
You're 500 miles away, but it's contagious. All right. Let me get back on track here. Let me finish what I was saying here on the gold. So, yeah, so I think this is going to be a better setup just around the corner here. But if you look over here in the weekly RRG, these are the gold miner stocks that we've been following. The momentum is fading in many of these miners because of the decay that we're starting to see there in the gold. But we do anticipate a great opportunity trade coming up for many of these just around the corners. They're almost most of the majority of them. There's a few over here in the improving quadrant. Majority of them are sitting there in the leading quadrant for now. So mixed price action going on right now with the corrective move in gold that we're seeing. All right, guys. To get more in-depth information regarding these opportunities and more, I highly recommend starting your trial subscription to our premier service, where you're going to get daily market and strategy updates and access to our member forum and a lot more of this. Check us out at tradinganalysis.com/subscriptions for that, please. That's all from me now, Bennett. Back to you.
Much appreciated. Thank you so much, Terry. Good work there in gold. If you guys are following our public content here on the YouTube channel, Terry put out a rotation update in gold. I followed that up last week with some technical analysis in gold futures. Check that out. And of course, as mentioned, check us out, tradinganalysis.com. We would most certainly appreciate it. All right, Alex, we're going to pass presenter mode your direction. I'm doing that right now.
I beat you
to
it.
I saw it go gray like right as I was about to click. You're on top of it. Love it. So Alex, if you could bring us up to speed, and before you do that, actually, yeah, I'll jump in. I had a question. I'll cover it at the end. So you ready to jump in there? You got the screen, and are you ready to rock?
Yeah, let's go.
All right, let's hit it. We'll be back on the other side. Markets are open. S&P flat out of the open so far.
Hey guys, again, welcome to the trading analysis. So I'm going to go as usual with a little bit of macro, gold and silver, and also cryptos. So let's dive in. 10-year yields, my levels has been crossed on the upside. I will have to switch my ABC wave count most likely to a more bullish wave count. We are trading at 2.418. And most likely the next resistance levels comes around 3.2, and then we can switch actually and count this as a potential 5-wave move on the upside, which will indicate that in a couple of months we might see at least a short correction in the 10-year yields on the downside for this B wave, and then most likely continuation on the upside in the 2023-24. So if we look across the spectrum and trying to see what we can see in the inflation front, we can also see a couple of other things. So I'm going to show you also the soybean chart and a couple of others, which indicates we are still going to see a higher level in most of the commodities, which implicates that these higher prices will actually still are going to keep the pressure on the world economies for at least maybe a 6 months to 1 year, and even more. We don't know how the global supply channels and also relations between the Russia and the West will go when this unfortunate war in Russia and Ukraine finish. So in that respect, I see across the board commodities continuing on the upside. We can also look this longer term chart of oil. This goes back from 1862. And I've been presenting this chart in the first instance before this, what happened in the war between the Russia and Ukraine. My levels was 137. We actually now trading in Brent around 114. We have been trading higher, but I still see some of irregularities in this wave count, which actually means that most likely this will continue to the upside with the first target at 146.52 and the secondary one close to 236. I don't think it is hard to imagine still in this situation this to be reached. And technically, if you look, we can label this as a big wave 4 starting from 2008. So if you look the chart, we have a wave 1 and 2, very nice subdivision in the wave 3. So you have a wave 1 and 2 up in 3, wave 4 around 2000. So beginning of the new century, and then we have a 5 waves up in a wave 3, ending around 2007, 2008 when we had a big drop. Which we can label as an A, triangle B, down in C. Before, when I was looking in a more stable period before the war, I was labeling this as a potential flat with a move lower. But I said a couple of times with our members, there is not much reason in current situation in a global glut and this geopolitical situation that we actually can't count oil to go down in the fourth wave so low around 24 22. So that will be really unreasonable. So that is one of the things when you do technicals and you do macro, you can kind of filter out some of the wave counts which might appeal to you to be good, but then when you look the fundamentals and some of the current relations in geopolitical situation, that will be really unreasonable. So I will switch here to a more bullish count, and if we go on a smaller time frame, we can also see that there is some irregularities here. If we count this from this low, and I will switch to a bar chart, we can count this as a 1, 2, but actually if we count this as a wave 3, it looks relatively small, and it's already very soon. If we go a little bit more upside, wave 3 cannot be the shortest one, so I'm waiting what is going to happen here. If we put equality, it's around 108. We trade now at 114. So I guess if we start to consolidate here, maybe the next push up will be towards and above 150, which kind of makes sense that this is not the end. This is just 1, 2, up in 3, 4, and 5 in the intermediary wave 3. We already start to see some of the steepening of this price on the upside, which is a characteristics if we continue sharply on the upside of the wave 3 of 3. So in that case, I will label this as a 1, 2, up in 3, 4, and 5 in the wave 3, then a pullback in a wave 4, and finally in 2000 or in a couple of 2 or 3 years or 2 years, I don't know how long this will take. We can actually look for some highs around 220 to 240. So this is not so easy to imagine in the current situation. I will say it was not so hard to imagine in the current situation, geopolitically one. Lots of things can happen in the different areas where the oil is produced. So I will inform you on the next sessions how this wave count goes on. But if you see from these levels, consolidation and the continuation above the previous highs, around 145, 47, most likely will be in the wave 3 of 3, going even higher in oil. So we have also the Thompson index, which is telling us as well that, let me just find it here, that is also telling us that we have almost completed a 5-wave move, and after a small correction, we might see a continuation of this CRB index going higher. Even we can relabel this, but it's too early. I will count this as an A down in B, up in C. But generally, this will, if we correct, this will be just a small pause before we continue higher. If we look also the dollar index, dollar is still trading sideways. We have a couple of scenarios here, and also it will be really unwise from us to keep the wave count, which calls for a sharp move down in dollar. That's definitely possible, but we need to see some signs. So in this type of situation, where the dollar is still a part of a safe haven and still a reserve currency, no matter what is going on a global scene, by Russia diverting from oil paid in dollars, but in rubles, and also China negotiating with the Saudis in regards of oil. So I will still leave this open and actually not take any sides until I see the clear break of this 95, 94 levels on the downside. Okay, so if we look the gold and silver, gold has been for me underperformer in this situation. We can still have a bullish wave count. I agree with Terry. This can be still some type of A up in B down in C for the wave 2. We continue on the upside, but I'm also looking more and to catch a signs for a larger move down in gold down to 1,675 and even a little bit below, especially if the dollar is in triangle and it breaks higher. Okay, so for gold, I mean, we just did $200 on the upside in the months ago, where the situation was actually for gold to go around 2.5, 3K at least in this type of geopolitical event, and gold just did $200, tested these highs and then roll over. So I'm still very suspicious about the bullishness on gold, immediate one. But still, we have to be cautious. We have to look what the gold is doing in these levels. If we go below these levels, definitely we will kick with the bearish wave count on gold in still ongoing wave 4. Okay, so the same situation is in silver. If you look silver, silver was as well not so convincing on the upside. So now we are trading below or in the line with the channel. We didn't see a clear 5 waves on the upside. We don't have any reason to mark this as a 5-wave move. So in that case, if golds continue to go higher or lower, and silver starts to breaking further lower, I think we will see the levels we looked before between 15 and 18 before we start to go higher. So silver was also very, very underperforming a type of safe haven assets in the situation we have been through. For me, that was really, really a big surprise from gold and silver in that regards. If we see some currencies, especially currencies which are dealing with commodities, we are pretty much bullish on them going forward. I would like Aussie dollar. I'm looking what it's going to do on these resistance levels. I will very glad to see it going down further. This will be also from some kind of a old technical analysis, a big inverted head and shoulder. Some of the older guys and even newer generation recognizing always this, but this is already included in the Elliott Wave analysis. This is just a correction and then a continuation on the downside, and then you have a beginning of a new correction on the uptrend and a correction. So that makes you actually head and shoulder. So we can see that also from the Elliott Wave perspective. So I'm looking what the Aussie dollar is doing at this resistance. A move down will be really great because I think we will fulfill ABC, and this will be then open for a big move on the upside in Aussie dollar and New Zealand dollar, which are commodity currencies, which also agrees with all of the narrative and the charts we showed in the different commodities and the CRB index. And generally the trend that commodities will have in year to 2 years and even maybe more on the upside. So I will focus on the commodity currencies. Euro dollar is still trading sideways. ECB is still not clear what they're going to do in situation. They are going to be in a much worse spot than Fed because they will have to actually balance their attempt to catch up with inflation and also balancing the situation in European Union, which now has actually will have much less available gas and oil. Economy will definitely tank to some point. You also have lots of people migrating or refugees from Ukraine. So it will need a couple of years to kind of adjust to these pressures. And I think that the ECB will have a very difficult task in managing this crisis from the monetary perspective. And I don't see them actually being so hawkish on rates because they need to take care of the economy and of the peripheral countries. We already have a sovereign debt relatively large. So I think they will strive not to be so hawkish as the Fed is in the future moves. So from that perspective, I will not be still looking to buy euro dollar here until I see what is the plan of the ECB. One of the things we noticed also on currencies is a big move up on dollar yen. We have traded around almost 126. I had a count where we pierced through some of the levels I was looking. We still didn't trade on the all-time high from 2011, so it's still a little bit more on the upside. So I want to see still what's going on with the dollar yen. Are it going to continue on the upside, make some type of a big flat and then roll over? So I'm not touching that because the situation is not clear for me. I'm going to show you a little bit more of cryptos. So total crypto market cap is actually doing what we were looking it's going to do from 2021. A triangulation still, we are looking for a wave DNE. And basically the Bitcoin chart is doing the same. We are still in a large consolidation. I would like to see Bitcoin crossing this 200 moving average on daily and going further up, testing this zone, which will actually, I will feel more confident to label this as a D wave. 40K is a very strong resistance. We are trading above 40K. I expect Bitcoin to come back to 40K in an E wave, and then I will expect some of the initial impulsive waves, which will actually confirm the reversal signature and out of the triangle, and then a further move on the upside. So for now, looking this whole consolidation, we cannot be bearish on cryptos. We are staying bullish on a total crypto market cap and Bitcoin, Ethereum, and a couple of other cryptos charts. So if you want to see more of that, visit me tomorrow for the Crypto Lab with Alex.
Thank you, Alex. Much appreciated, sir, as always. Go ahead, Terry. Were you going to say something? I didn't mean to interrupt.
Very good, Alex. I like that. So there's another opportunity. If you didn't get in on the Bitcoin long, there'll be another opportunity coming up later this year is what's forecasted there. I like it.
I'm going to call June 35 to 40K finish for the triangle. We'll see what happens.
Yeah, I agree.
That'll
May,
be a fun
June.
one. Yep.
Yeah.
Yep. Excellent work, team. Appreciate it as always. And if you're interested in more crypto-specific coverage, tomorrow morning, right here on the channel, 9 a.m. Eastern for Crypto Lab. We should call it Crypto/Macro Lab, since you've been covering some macro stuff there as well. But appreciate it. Check us out, tradinganalysis.com. Please give it a thumbs up and subscribe with notifications to the channel if you are enjoying the content. We will be back same time, same place next week. Alex, Terry,
Thanks, guys.
have a good one. Members,
See you
we'll see you
guys.
in about 10 minutes for our webinar. See you, Alex. See you, Terry. Catch
See
you
you.
guys
Bye-bye.
next week. Take care.